Hello everyone, welcome to iExam. The Bank of India Credit Officer exam, the professional knowledge plays a very important role. In our previous video, we had discussed in detail the syllabus for all the three subjects of English, professional knowledge and GA that you need to prepare for this exam. Today in this video, I'm going to take up one of the very important topics for your professional knowledge, which is the types of credit. So we will discuss the concept of types of credit and also practice certain MCQs from your exam point of view in this video. So do remain with me till the end of the video. Before we start with this video, I would like to remind you that today, the 10th of May, is the last day to apply for this post of Bank of India. So if you are eligible, if you are a CA, if you are a CS, if you have done CFA, and there are other qualifications that are mentioned that in the eligibility, then please do apply. If you are still not applied, today is the last day for applying for this particular exam. So let's start with our topic, types of credit, which is an important part. So overall, your professional knowledge can be categorized into 6 broader aspects. Today we are going to discuss about one of them, which is the types of credit. So when first let's understand what do we mean by credit facility. You may be interested in buying certain products, say white car or a home. So in that, there are 2 ways that you can fund yourself, your purchase. One could be through your own savings and your money, and the other could be that you take some help with the from an external institution like a bank, where you borrow some money. So when there are borrowers, various kinds, these could be companies, these could be individuals. When these borrowers approach a bank for availing of certain loan or some funding, the bank may give them a loan, and these are exactly what credit facilities are. So credit refers to the loans or advances that they may be extended by the bank or any other lending institution to the businesses or personal individuals for their requirements. Right? So here, like I said in your example, if you want to buy a home, you want to purchase home, and you may approach the bank for a home loan. Similarly, if you want to buy a car, you may approach the bank for a car loan. Or there may be a company, which wants to fund a project, and they may approach the bank for a project loan. So these different kinds of loans or advances or help that they are looking forward to are known as the credit facilities. So what are the different kinds of credit facilities that the banks offer to various kinds of borrowers? So there are various ways we can understand them. If we talk about credit facilities based on the tenure or for how long these facilities will remain, we can categorize them into long term or short term. So short term is usually something that will come back to you in less than a year. That is the standard that is mostly used, and long term is maybe something which takes more than a year to come back to you, to the lending institution. So say for example the bank. So some of the common types of credit facilities that fall in the short term category are your cash credit or CC limit, as it's also known as, or the overdraft facility. There could be short term loans for less than a year, and trade finances that the banks can be extending to corporates or MSMEs or certain companies to meet their working capital requirements. Then there can be long term loans, which can be in the form of bank loans, which are also called term loans. There could be notes, there could be mezzanine, there could be securitization transactions that a bank could be funding, or there could be bridge loans. Bridge loans are the loans which help you to tide over or to arrange for funds till the time you are arranging for funds. The bank may be funding you for your duration. That is known as the bridge loan. So these are the different kinds based on the long term or short term. So one thing I would also like to state here, So crash credit limits, the CC limits, are basically also revolving in nature. So there is one more terminology, revolving credit. Right, so what we mean by revolving credit is, although CC limits are given to you for up to 12 months, they become due for renewal as soon as these 12 months lapse. So if we say, if I was sanctioned on 1st of April 22 for 12 months, on 31st March 2023, if they are expiring, they are renewed from 1st of April 2023 again. So in that case, basically they become a revolving, they keep on going round the year, available to the borrower, and in that case effectively banks may sometimes treat them as long-term facilities, although by definition they are short-term, because of them being available for 12 months at a single stretch. So these are certain practical things in the banks that are used, but from definition point of view, we will categorize them as short-term loans. Another way to categorize credit facilities are based on the security or the collateral that has been provided, whether they are secured or unsecured. So if there is a collateral backing the credit facility that the bank has lent, then it becomes a secured loan, while on the other side, if there is no collateral or security that is available against the loan or the credit facility that the bank has given, it is known as an unsecured loan. So some differences between a secured and an unsecured, of course the first basis as per definition is the collateral. Is there any security or collateral backing on which the bank can go back in case there is a default or non-recovery happening? The other is when the bank is assessing whether to give the credit facility as a secured and unsecured. In secured, the basis or the amount that you will be giving as the credit facility will be based on the value of the collateral. So in this context, you might have heard a term of LTV, which stands for loan to value. This is especially very important in case of say home loans. Right, so the bank will, if you go to the bank to get a home loan, the bank will not give you 100% funding. What that means is, say if the value of the house is 50 lakh, the bank will not give you 50 lakh of loan. They will say that we are giving you up to 60%. In that case, they are giving you only 30 lakh of the loan. So the value of the house is 50 lakh, but you have got a loan of 30 lakh. So 30 by 50, this becomes your LTV, right? So based on the value of the collateral, a secured loan will be given, right? So whether to give 30 lakh or to give higher will depend on what is the LTV rule that the bank follows for that type of a loan. So that is what we mean by based on the value of collateral. While unsecured loan is mostly based on the credit worthiness of the borrower, because there is no other collateral backing it. Therefore, the bank will analyze how credit worthy, how good the borrower is that we should give him the loan and to what extent. The tenure, the loan term, usually in a secured loan can have a longer repayment terms, while unsecured, because they are unsecured, there is a higher risk. The tenure of these loans is relatively shorter. The interest rates, again based on the risk, is higher in case of unsecured loans and lower in case of secured loans, because the risk in unsecured is very high, therefore the interest rate charged is also higher. So some of the examples of secured and unsecured loan typically consist of, your secured loan is a home loan, a car loan, a project loan, are typically the examples of secured loans, and while unsecured loans can consist of your credit card bills. So there is no collateral backing your credit card. Right, the personal loan, sometimes the banks may sanction. There are pre-approved personal loans that the banks offer. They are based on the credit worthiness of the borrower rather than any kind of collateral. Another way to classify or to understand credit facilities is based on the purpose or the types of loans that the banks are supposed to give. Say based on purpose, what we have already talked about, there could be agriculture loans which are given for agricultural purposes. There could be education loan given to fund the education of a child or a person. There could be a home loan, which is basically a loan to buy or repair or refurbish a home. Then there are PSL loans that the bank have. PSL stands for priority sector lending. So as per RBI rules, banks are supposed to provide priority sector loans up to the extent of 40% of their ANBC. What is ANBC? Please write in the comments box the full form. Such kind of questions also come in the exam where abbreviations are asked to be expanded. So you can write in the comments box what is ANBC stand for. Right, so these are for generally banks. There are certain kinds of banks which have to give a higher level of PSL also. Then there are Mudra loans. So in 2015, the government had come out with a Mudra Yojana, PM Mudra Yojana, under which certain loans of different categories, different amounts can be extended to the MSME sector to make availability and to give impetus to the MSME sectors in the country. This Yojana was introduced in 2015. So these based on purposes and for various particular sectors that the government or the banking system can come out with certain schemes or types of loans can also be another way of understanding the credit facilities which the banks give. And one of the very, very important ways of understanding credit facilities by banks is to categorize them as fund-based and non-fund based. What we mean by fund-based is that they lead to immediate flow of funds to the borrower, right, from the bank at the time of sanction. So if I am given a loan, I will also be given the money. Non-fund based credit facilities are those where the bank states there's no immediate flow of money happening from the bank to the borrower at the time of sanction. See, eventually there may happen. However, at the time of sanctioning such a facility, the bank is not leading to any flow of funds. In fact, they are giving you a promise or that at a time of a certain fulfillment of certain conditions or in the happening of an event, I will pay you and you will be you have this facility that you can avail from me, but at the time of sanction there is no fund flow happening. So that is the major difference, and there's a one very important ways of categorizing the credit facility. So if I have to look at some of the fund-based and non-fund-based facilities, fund-based would include your working capital limits, your CC limits, your overdraft, your retail loan, your term loans, bill discounting and export finance that may happen in the form of some term loans or working capital limits. Non-fund based basically are of two types, your bank guarantee and your LC or letter of credit. It is also known as documentary credit, right? So these are the broader ways of categorizing. The different ways I have told you of categorizing, they can overlap. Like for example, a term loan is a fund based facility. It is usually also a secured loan. It is also a long term loan usually. Okay, it could be a short term, it could be a long term. Usually they are secured, usually they are long term. However, there can be short term loans, there can be unsecured term loans also, right? So as I there are different ways. Major way of understanding is fund based and non-fund based. I hope by this you have been able to understand some very important type of credit facilities that banks offer to various kind of borrowers. So this was a glimpse of the crux of the topic. It doesn't end here, but through some MCQs, through some question and answers, I will help you understand what type of questions from this topic have come or can come in the exam. So let us look at the first question. A facility to withdraw money from a current bank account without having a credit balance, but is limited to the extent of the borrowing limit which the commercial banks fixes, is known as which of the following? Is it a term loan? Is it a fixed deposit? Is it cash credit, letter of credit, or all of the above? The correct answer here is cash credit. So cash credit is a working capital limit that is extended by the bank, in which case you don't have a need to have a credit balance. However, as and when you require fund, you can avail and withdraw from this facility to the extent of the amount sanctioned to you. So this is known as a cash credit limit. Usually banks extend it to businesses for meeting their working capital requirements or short-term requirements, operational requirements in the businesses. So there is another important concept related to your CC limits, which is the drawing power. It is an important concept. There are various ways of calculating and understanding it, which is again important for your exam. Let's look at the second question. Say if you want to purchase an iPhone through securing a loan. So iPhones is a smartphone by the company Apple, which are usually very expensive. So in case you want to buy that phone and you need a loan from the bank, which type of a loan is most likely you going to take from the following? Will it be a term loan? Will it be an overdraft? Will it be a cash credit or a revolving loan? So answer here is a term loan. All the other limits, if you will see, are basically working capital limits. It is an overdraft, a cash credit limit, as I explained, or a revolving roll. So revolving roll also I was explaining when I was explaining the cash credit. It is basically a working capital limit which is being renewed at the end of the last cycle. So in effect, basically it becomes a continuous kind of a loan that is available to the borrower. So in this case, because it's an asset you are trying to fund, it is more of a term loan which you will repay through certain EMIs, right? So what are the characteristics of a term loan? A term loan is basically paid to you, to the borrower, in a lump sum big amount, and you as a borrower have to repay it back to the bank in certain installments along with the interest. So that becomes a term loan, right, where you have a lump sum amount and then you are repaying back in installments. In overdraft, cash credit, or revolving limits, basically you have been given a limit up to which you can withdraw money from the bank, and whenever you take that much money, you pay interest on that outstanding balance only that you have taken from the bank. So once you return that money, again you can avail the limit. So say for example, if you have a 25 lakh cash credit limit and you use say 15 lakh out of it, now you can use additional 10 lakh, right? However, if you use 15 lakh and after say a week you repay back that money and your balance outstanding becomes 0, again you can avail 25 lakhs. So that is how a cash credit limit works, that it is a limit given to you and you can keep using it as per the requirement during the time of the active life of that particular limit. So if you want to practice more questions and the entire exam for all the three segments, which is English, professional knowledge, and GA, the full mock tests are available on iExamB website. As you are aware, all mock tests on iExamB websites are free. So you can go at iExamB under the free mock test column. You will find the mock test for Bank of India Credit Officer. 2 mock tests are available for you to practice there. Moving ahead to the next question. What are the different types of loans that are associated with Mudra loans? So I told you that Mudra Yojana had come in 2015 to provide loans to the MSME sector. So there are 3 types of loans actually that are available under Mudra Loans. So what are the names given to them? Is it A, micro, small and medium loans? Is it B, Shishu, Kishore and Tarun loans? C, Udyam, Krishi and Shram Yogi loans? Or D, Kisan credit card and interest subsidy loans? So which or none of the above? Which of them are the Mudra loans? The correct answer here is B, Shishu, Kishore and Tarun. So they within the Mudra loans, there are three categories that have been made based on the amount, the upper limit on the amount or the range of the loan that can be taken. So if the loan is up to 50,000, it is known as a Shishu loan. If it is between 50,000 to 5 lakh, it is known as the Kishore loan. And if it is between 5 lakh to 10 lakh, it is known as the Tarun loan. So they have been associated with the ages of the loans, the amount as you grow, right? In the amount, they have been named accordingly: Shishu, Kishore and Tarun. So this question actually was also there in 2020 BOI professional knowledge section. Another question: if a person purchased a machinery and he wants to make payments in installments, which kind of a guarantee is related with this? Is it a bank guarantee? Is it a performance guarantee, accrued guarantee, a deferred payment guarantee, or an absolute guarantee? Right? The correct answer here is deferred payment guarantee. So this is a kind of a non-fund based facility. So when I was telling you about non-fund based facility, majorly I talked about two. One was your bank guarantee and the other was your letter of credit. So bank guarantee can be further divided into three or different types, not really three but various types, one of them being financial guarantee and the other major being the performance guarantee. And your deferred payment guarantee, either you can call it as a third type or it is a type of a financial guarantee also. Right? So what happens in this is, as it is non-fund based, if the bank has given you this guarantee, basically bank is agreeing to make good to the third party in case the borrower is unable to pay or does not fulfill the obligation on his part. So in a financial guarantee, what happens is bank is issuing a certificate stating that the borrower has the financial bandwidth, creditworthiness to meet the obligation to the third party. In case the borrower is not able to, then the bank will pay on his behalf. In case of a performance guarantee, and this may happen especially with a lot of tenders in the government sector that people apply to. So in the performance guarantee, whatever the borrower has to perform as per the agreement with the third party, say for example the government under the tender, what they have to perform, in case they do not perform to that level or in the time that has been stated, the third party, say for example here the government, if they are suffering any loss, then the bank will make good the monetary loss in that case. That is the performance guarantee, that I am as a bank guaranteeing that the performance by the borrower will be made as per the agreement with the third party. So that becomes a performance guarantee. A deferred payment guarantee actually is used when you are buying certain capital goods, say a machinery as given in this case, or if you are importing certain machinery, right, then the supplier or the seller of that machinery has agreed to take payment in installments, right, and here these payments are being deferred, right, so they are being paid in a deferred manner to the seller. So here it is known as a deferred payment guarantee. So it's a kind of a financial guarantee. So this question was also there in 2020 in the BOI professional knowledge section. So if you want to see the complete list of questions that had come in 2020. Again, on iExamB website, under the previous year questions, you can go and attempt for both 2020 and 2018 the complete paper for Bank of India. Both of these mock test and previous year papers are available for free on the website of iExamB. The last question for today: banks are required to use external benchmark lending rates for which of the following types of loans? Is it A, all new loans, floating rate personal or retail loans like housing and auto loans, or floating rate loans which are extended by banks to the micro and small enterprises from October 1, 2019 onwards, or the floating rate loans to the medium enterprises from April 1, 2020? So is it only A or B, B or A or C, B or C, or all of the above? The correct answer here is all of the above. The external benchmark lending rate system was introduced by the RBI in 2019, where these loans had to move to an external benchmark lending rate. You can mention in the comments box what are these external benchmarks that the banks are allowed to use for deciding the lending rates for these three types of loans. So for them, these loans, it is compulsory. For other loans, you can do it on a voluntary basis as of now. Otherwise, the other loans are the banks use is the MCLR as the basis, which is an internal benchmark for the banks, right? So in the comments box, do write what are the external benchmarks which the banks can use for basing the lending rate for these three types of loans. So that's all for today. Just to remind you that at iExamB we have a course and the live classes for such fruitful in-depth discussions based on all the important topics has been going on. We have already done fourth class, and our fifth class will be held today related to the accounting principles and the topic of depreciation, which is very important, and questions have been asked in the past. We continue to do the classes throughout the month of May till the 27th, and thereafter we will do all revision, important aspects, important questions and answers. The guidance is being provided by experts in various subjects, whether it is professional knowledge, English language or general awareness. So as you can see, there's Shikha ma'am, who is ex-deputy manager for State Bank of India, myself Prachi Agarwal, who am ex-manager care ratings and I've been a faculty for finance of the last 5 years at iExamB. Neha ma'am, who's an academician with 5+ years of experience. Arunima ma'am, who's ex-manager SIDBI and an expert in guiding for bank exam preparation, and she's been doing this from last more than a decade. Manali ma'am, an expert in English with 7+ years of teaching experience. Sushil Ragre sir, ex-manager RBI and has been mentoring for various government job exams in the banking space for more than a decade now. And Amit Pari, a GA expert with more than 5 years of experience in the government GA space. So if you need any more information related to the Credit Officer online course, you can reach out to us on the number mentioned on your screen or visit our website. Thanks everybody for joining in. Wishing you all the best. Don't forget to subscribe to the channel and press the bell icon so that you are updated about the next videos in this your preparation for Bank of India Credit Officer.